Good afternoon, Insignio family. Today is Thursday, October 26th, and we are joined with First Trust economist Andrew Opdyke. Andrew, welcome to the call.
Hey, thank you for having me.
Absolutely welcome. So Andrew works on the team with Chief Economist Brian Wesbury as part of the First Trust economics team. Can you tell me a little bit about how that's set up and what's your day-to-day look like?
Yeah, so I work with Brian Wesbury, our chief economist. We've got Bob Stein, who's our deputy chief economist. There's me, four other people on the team. We split our time between mornings, which is typically writing. This morning, we had durable goods. We had the GDP data. And then we spent a lot of our time traveling the country. I just got back at about 2:00 this morning from Connecticut. We're all basically on the road. We spend our time meeting with advisors, meeting with businesses, talking with small and mid-sized business owners. So that's kind of the split on what we do. We want to see the data. We want to write and interpret and try to provide you with information, talking points for the conversations you are having with your clients. But we also spend a lot of time because we want to see it in person. And we primarily focus here on the US markets, but we do also have some activity up in Canada, Latin America, Europe, and over in Asia.
And clearly, what a time to be alive right now. Data that we're seeing coming out, I mean, talk about mixed data and you know the thesis of there's no such thing as a one-handed economist, right?
Yeah, right. And we're sitting here. It's a tricky time. This morning is a great example. You had GDP data that came out quite strong for Q3. And people aren't sure whether that's good news or bad news. On one side, it means the consumer spending a little bit more. It means that activity is moving ahead. The question of, are we going to see a recession? They say, well, maybe this points us in that other direction. But at the same time, the strength in that activity, strength in consumption is a signal that keeps telling the Fed, you may have further to go. So today, and we see this with employment, we see it with the inflation, markets are trying to figure out, is good news bad news? Is bad news good news? How do we interpret? Because we don't really have a playbook for this. We've never done what we did in 2020 and in 2021 with the shutdown, the shelter in place. There's no playbook to say, here's how everything evolves as we move past that. And today, I think the Fed in particular is really trying to get a firm grasp on how much work is left for them to do to get inflation towards that 2% target that they, quite frankly, thought they were going to be at by the end of 21.
Sure. And, cycles rhyme, nothing exactly the same, but the most four expensive words is this time it's different. Right. So on one hand, I mean, we were seeing key confidence measures and surveys, which continue to indicate, big downside for the economy. And yet, like you mentioned, this morning's, data is just kind of pointing to a pretty robust third quarter performance. What about the money supply?
Yeah, money supply to us has been a critical piece. If you go back, this was our big disagreement with the Federal Reserve in 2020 and in 2021 when they kept saying, look, inflation's going to be temporary. Their argument at that point in time was it was the supply chains. You turned on the TV and you saw the Port of Long Beach. 111 ships waiting offshore, 11 days to dock and unload. And they said, look, if we get those supply chains fixed, that's going to bring inflation down. Everything is back to normal. And we said, look, hold on a second. We added money to the system between the PPP loans, the direct stimulus checks, the additional unemployment benefits. The measure we follow is the M2 money supply. That's checking accounts, savings accounts, money market funds, currency, and circulation. Let me be clear, that is not quantitative easing. If you go back to 2007, 2008, 2009, when the Fed does quantitative easing, what they're doing is they're coming to the banks and saying, we're going to buy your treasuries, we're going to buy your mortgage-backed securities, and we're going to give you reserves. We're essentially a cash equivalent. We will create liquidity in the system. But what we saw back in the financial crisis is that even though the Fed did that asset swap, the banks didn't lend the money. Well, this time we bypassed them. And that led to, my undergrad degree was in economics. I did my grad school at Northwestern in economics. I did the CFA program. You don't need to take a single economics class to know that when you give people money, they will spend it. And as that money came into the system, we had this wave of demand, this wave of purchasing power. At the same time, the employment, March and April of that year, it fell 22 million jobs. as we were recovering, trying to get the jobs back, we had enormous spending power. And that pushed inflation, even as the jobs got back to where they were at pre-COVID levels. That's why I believe the inflation pressures were still there. We're still in the process of sopping up the excess money in the system. That said, the Fed and the Treasury are now moving in the opposite direction. They are actually taking money out of the money supply, which is something we very rarely see happen. This is the first time we've seen it in more than 60 years. And you'll notice if you watch, the Fed will talk about it, different networks will talk about it, things like the Senior Loan Officer Opinion Survey. Banks are getting tighter on lending standards. And for consumers, credit is getting harder to come by. The single biggest concern of small and medium-sized businesses, as of the latest survey, was that it's access to credit. For 2 years before that, it was finding qualified workers. Now they said credit is becoming an issue, and that tends to lead to knock-on effects from a growth standpoint because it impacts their capacity to borrow and invest in people, invest in products, invest in projects. So while we sit here today and the third quarter GDP number was strong, that credit hit, that credit tightening, it's almost like we had a tsunami, this huge wave of money, and a little bit of that riptide is starting to be felt. And I think that's kind of the concern is as the money gets pulled out of the system, we may see a slowdown come faster than many people are anticipating.
Certainly. I mean, we have to go back decades and decades to see another year in which the M2 money supply was negative.
Yeah.
Right? And it's not by just a marginal, snippet. It's sizable. So
yeah, this is the largest since the 1930s, right? The last time they really pulled money out of the system, it led to the Great Depression. And I'm not saying that's what we're expecting to see right now, but there is, even under the Volcker years, when he was fighting double-digit inflation, they tried to stop money from growing, but they didn't actively take it out. Certainly something we need to pay attention to.
Correct. So Fed jacks up rates. Where we're at right now, growth seems to be, there's a story to suggest that growth is going to be fine. Mm-hmm. But what about this last mile that we've got to digest as an economy?
Yeah, it's kind of so the question of how much further they have to go, but the really important question of how much longer they have to stay there. We know from history that monetary policy operates with a lag. If they raise interest rates and it becomes more expensive to buy a house or buy a car, right? We don't see that wipe across the economy immediately. It takes some time before businesses are replacing equipment, consumers are making certain purchases. The question of how much of a lag it is a really unknown. Usually, historically, it's been about 18 months, which means here in the next 4, 5, 6 months, we should really start seeing some of the impacts of that Fed tightening cycle. But the Fed's arguing maybe it goes through faster, maybe it goes through slower. They're not quite really sure. Here's what I will say is that over the next 2 years, there's a lot of debt coming due. Next year, 2024, it's primarily investment grade. 2025 is when we really start seeing some of those companies that were able to access capital at very low rates in 2020 and in 2021. Remember, they extended their duration. They borrowed at low rates. They took loans out for 3, 4, 5 years. We are going to start hitting that. And that's when we're going to get this test of, as your cost of paying, as your interest cost rises, do you pull back in other areas to protect margins? Do you pull back in other areas just to make sure you've got the capacity to make those payments? So if the Fed has to hold through next year, let's say they don't make a single further hike, if they have to hold for the next 12-ish months, that means we're going to be exposed during this time period where a lot of debt is renewing and it's going to be rising. Average carrying cost, even on investment rate, is going to be rising 1.5% to 2.5%. So, even if the Fed does not move more, some of that impact certainly is still to be seen. Sure.
And when the Fed starts to cut, why they're cutting.
Yeah,
it's pretty straightforward. Given this cycle, there's some indicators that might be less important than in other cycles. We're always subject to revisions on things that could have seemed very optimistic, and then later on, they get revised downwards. Give us a little color on what might be different this cycle.
Yeah, well, there's a couple things that are a little bit different. One, again, is that money in the system. The government's been trying, a lot of people have been trying to figure out how much capacity do consumers still have. And this number has actually gotten revised a lot over the last 12 to 18 months. They run estimates, personal income and spending. We're going to get that data tomorrow morning. I'll write that report. The amount of money from their after-tax income to how much they spend, the gap between that is the savings rate. And we saw a big pickup in the savings rate early in COVID. People had the extra money flowing in. They built up in their checking account, in their savings account. And so, a lot of businesses are wondering, when have consumers tapped out? When have they spent those excess funds? In which case we would expect growth to slow. Well, the government was watching those numbers. They were giving us prints and they heavily revised it. So that's been an area where we haven't had much clarity. Another area that's operating a little differently is employment. And if you think, it makes a lot of sense when you stop and think about it, right? Right now, companies are very hesitant to let workers go, because we're still, even with 5.5% rates, right? We are at a sub 4% unemployment rate. And what they just witnessed over the last 2.5 years is that if you let employees go, it was very difficult and quite expensive to get them back. This is one of the core issues that's keeping inflation elevated, is that in 2020, 2021, right, we moved workers, we moved investment dollars, we moved inventories to the good side of the economy in order to try to ease supply chains, in order to pass things through. That was when we were living this world inside and online. Now that we're back out and traveling, now that we're back at restaurants, back at sporting events, back at concerts, those businesses are just getting back to pre-COVID levels of employment, yet their demand has exceeded. And so, in a normal environment where the Fed is hiking, you would expect to see companies starting to let workers go earlier. We're not seeing that so much this time around, but we are seeing some signs that those workers, in some cases, have less to do. The hours worked is falling in some of these categories. And that, if you run the numbers on it, if the U.S. economy, the U.S. worker on average works 1/10 of an hour less, which is not a whole lot, it's 6 minutes. But when you have 158 million workers working 6 minutes less, that equates to about 450,000 full-time positions. So if we get an employment report that says we added 180, 200,000 jobs, but hours worked fell, it means we actually worked less than the month before, even though we had more people. And this dynamic of businesses having felt that experience of losing workers, trying to get them, watching the United Auto Workers strike, watching the renegotiations with the UPS drivers, watching the pilots unions, that has kind of tightened up the labor market. And the last thing I'll say on that front is there's also a demographic shift taking place, right? The group that we're seeing participate at lower rates today versus pre-COVID is primarily the 55 and older. It's the baby boomers who are naturally reaching that age where you would expect to see more retirements. And over the next 5-10 years, we're going to continue to see them leaving the labor market, most likely, which is going to bring overall labor force participation down. What that means is that businesses as a whole have a not a darkened picture, but the pathway to bring on employees is not going to get easier here in the short term unless economic pain is really felt. That is one of those things that's very different from what we've seen in prior downturns, where those higher rates, people start cutting a lot sooner.
Sure. Forecast for the treasury market is, that's going to be a major component in a lot of valuation models. And if we can't get the treasury yield correct, everything else kind of breaks down.
Yeah. So, as we look out towards the end of this year, I would not be surprised to see the 10-year treasury break 5 and stay above it for a little bit. There's a couple factors moving on that. One is just issuance. If you think, we just finished fiscal year 2023 for the U.S. government. It finished at the end of September. We're getting the final numbers right now. We ran a $2 trillion+ deficit, about 6.5% of GDP. And in fact, it was worse than that, except that they got credit. They got a revenue credit this year when the Supreme Court struck down the student loan repayments, which in 2022, we thought those were going away. But, President Biden came out and said, we're going to cancel those. It hit the budget in 2022. They got credit for it this year. People are looking and saying, man, are we really going to keep going? Is 2024 going to be another $2 trillion year? We're certainly not going to pull back on defense spending, not with what's going on with Russia, Ukraine, now with what we've got going on in Israel. We've got China and the South China Sea. There's a lot of issuance that's coming. And the question is, do we have the demand to meet it? We've seen a little bit of weakness in Treasury auctions. So, could we see a 5.25, 5.5, 10%, or 5.5% 10-year Treasury? I think we're more likely to see us in those fives than to see us drop below the threes. I think in that four area, 4.5, 5.5, people are going to have to make some decisions here. And we're also going to have to watch a conversation I was having this morning internationally, right? Go back 3 years ago, and we had over $10 trillion in negative debt trading around the world, right? Europe was largely negative. Japan was negative. That was an anchor to US rates. And everyone is dealing with these inflation problems. And in fact, Europe in many places is dealing with it worse than the US because of their exposure to energy costs. And so that anchor has been lifting. I think that's going to keep some pressure elevated. If I'm looking out a year from now on the 10-year Treasury, I think we are probably in this, 4.75 to 5.25 range, unless we felt a more significant downturn to the point that the Fed says, hey, we believe inflation might be managed from this pullback in demand, which would drop inflation, and therefore they start the cut cycle. But personally, I believe the path to getting inflation down to 2% is going to take them longer than they think it will.
Certainly. And so what you're describing, the structural versus cyclical forces at play in the Treasury market.
Yeah, exactly.
It's certainly interesting. Mm-hmm. Let's talk about yield curve, and we're starting to see some pretty meaningful uninversion, which typically kind of happens before recessions.
Yeah.
What are your thoughts there?
Yeah. So one of the major questions in the bond market is term premium, right? Like how much are people willing to pay, or how much demand is there if we're going to lock in on 10, 20, 30-year debt, particularly again at this time period where U.S. spending has been unchecked. A lot of people are like, do I really want to do a 30-year Treasury where if the Fed doesn't get spending in check, that could continue to put inflationary pressures and that could diminish the value of my dollars. I do think we're going to see kind of that we're moving toward that uninversion. I think we will see it flatten out and go positive, but I think more of that movement's going to come on the long end. I think the movement lower on the short end of the yield curve, if the Fed cuts next year, I think we're probably looking at about 50 basis points worth of cuts. And then the year after, maybe 100 to 150, depending on how much inflation has come down, right? So at that point, even if we see 150 over the next 2 years, that still puts us at the high threes, right? 375, about 4%. And so if we're uninverted at that point, it means the long end is still over 4.5, 5. If the budget does not get addressed in the next 12 to 18 months, I think we could see more and more pressure rising on that term premium. The bond vigilantes are back. And they're saying, look, we are going to demand compensation if you're not going to check what you're doing.
Certainly. I mean, if you were analyzing the balance sheet and you just kind of covered up who it was coming from, it would not be the same kind of trade.
Mm-hmm.
What about housing and housing starts?
So housing is an interesting one. Housing starts in the overall housing market. If we think about existing home sales, let's start there because this is an area, right? Home sales for existing homes has fallen dramatically, and it makes a lot of sense. Again, if you look back to history, it might not repeat itself, but it rhymes. It looks a lot like 78 to 81 when Volcker was coming in and he was jacking up rates. At that point in time, people were looking and saying, hey, I got my loan, I bought my house, and I bought it, and I locked in a mortgage at substantially lower rates than where we are today. Today, people are looking and saying, I locked in a rate at 2.75, 3.25. Why would I move homes and take on an 8% 30-year mortgage? And it's not just that. There's also a tax component of this. Back in 2020, when people were home, they were doing work on the house. They were doing work on the outside, the roof, put a pool in the backyard, whatever it may be, because that's what we could do. And so now they also know there's tax consequences with this if they sell and potentially downsize. Existing homes, I would expect to be largely flat until we start seeing rates make that move lower. New home starts, we're seeing some interesting things. The second largest demographic group after the baby boomers is the 30 to 39-year-olds, which is prime home buying age, prime, family formation. This is a time where you would expect demand for homes to be there. But they're getting priced out of some of this. What we're seeing from the home builders right now is saying, okay, we're going to start focusing on smaller square footage homes. Instead of the 3,500 square foot, we'll start moving towards 2,500 square foot. Average price may start to moderate a little bit, not because the homes that are out there, they can't get the price they're asking for, but because they're building slightly cheaper, more accessible homes. I do think, we had a shortage of housing stock pre-COVID. We were short about 3 million homes. We are still short homes, given our population, given scrappage, natural deterioration of homes over time. It's really the existing home side where it's going to be tough. There's going to be some headwinds. Some people may be pushed towards renting because of those mortgage rates. But as soon as those rates start to fall, I think we've got a strong tailwind behind us to start absorbing whatever gets brought onto market. In the short term, there's just not a lot available to buy.
Looking at what other shocks to the system could impact your guys' forecast. I mean, long run inflation expectations right now in the face of rising oil prices as one example. Thoughts on that?
Yeah. So, I mean, there's a couple different things that we are always watching out for. Geopolitical conflict. If Russia, Ukraine were to escalate, or if Israel, let's say Iran were to get involved, you could see a more significant escalation. I mean, the worst would be if China invaded Taiwan, right? Those type of geopolitical conflicts could cause significant repercussions from an economic standpoint. Oil prices being higher, I would say, honestly, oil in the 80-ish, 75, 80, 85% range is probably the longer term average. When we saw the major production from the United States, we saw the fracking revolution, which wasn't profitable in some cases for energy producing companies. It was a drill baby drill environment. We brought rates down. We had oil down at 35, 45, 55. We are no longer kind of that producer who's offsetting, who's shocking the system. U.S. production has kind of stalled out, and they've been incentivized to do that. The power has shifted back towards OPEC, and I think they're going to keep these prices elevated. So we, to a degree, are pricing that in. And remember, energy, it's not just the cost to put gasoline in your car. It's not just the cost to heat your home. Anything you buy, the shirts that we're wearing have to get transported to be brought to us. The coffee beans that we, grind in the morning that we roast up have to be brought to us. That energy flows through transportation costs and continues to put a little bit of upward pressure. So we watch out for things like that. The biggest wild card for us, right, other than the geopolitical conflict, is this budget issue that's in Washington right now. We cannot run 6.5% of GDP deficits. And the major question, we saw this in the late 70s. When does the population get so fed up that we start voting for people who are going to take it more seriously? And this is not a Democrat or Republican, both sides, right? The last president to run a surplus was Bill Clinton. Right. And then since that, each successive presidency has kind of increased the deficit, increased it. We saw in the late 70s, we saw people vote towards more disciplined spending, to some changes towards the regulatory environment to promote growth. And for about 16 years, that became a central focus. I think we could see that. But until we do this, the rates, the rate reset, companies having to make decisions on what projects make sense at a 5.5%, 6% investment grade borrowing rate versus 1.5% 4 years, or 3 years ago, right? That's going to impact how many projects they bring to market and what type of revenues they need to see in order to make those investments. That is going to be a significant story, I think, over the next 5 to 10 years.
Certainly. I mean, budget deficit, you've got the bond vigilantes, to your point, have already been voting. That voting mechanism is already clearly, well on its way in play, probably more so than the populace kind of, rising up and, getting some folks that would be more, fiscally conservative.
Yeah.
So it's an interesting dynamic. Team, a reminder, if there are any questions, you can put them in the chat for Andrew. What would you think about a private credit bubble?
Yeah, it's one of those things. It's kind of hard to see through. Obviously, there is some private. If you remember the SPACs back in 2020 and in 2021, there was a lot of money going into these SPACs. That were going into these entities, right? There was private credit going to take companies private or try to incentivize. And at that point in time, because money was so cheap, there was a lot of investment in unprofitable companies. And we're starting to see again. We see this in the bonds. There was some rising stars. There were some people that saw their credit scores upgraded. There was some now that are going to see that fall. My biggest concern on the private credit side is with the Basel III that's going through, and the banks are talking about this. The central banks want to more heavily regulate the big banks, right? And JP Morgan, Jamie Dimon went off on this in the recent earnings call he did at the Barclays conference a few weeks ago. He said, look, what you're doing is you're raising the costs on us big banks who are we're better capitalized today than we've ever been. And you're pushing more and more of that funding, of the access to credit into these private entities, which are not as heavily regulated. They're not overseen in the same way. And his argument was you're increasing longer term instability. But the reason the Fed seems to be doing that is to say, look, that's not our problem. We will control what we can control. And so I do have some concerns on the private credit side that over the next few years, there may be pockets that are showing up that are more unsustainable, but we don't have as much visibility into them. That could certainly be, quite honestly, I still think there's still the small banks, the regional banks, some of the local banks. You've got things we talked about, real estate. In terms of housing, there's the office real estate, which is still an issue right now in the big 20 cities. Return to office, about 49% of people are returning to office on any sort of regular basis. So demand for office units is declining. Renewals on leases is declining. There are certainly going to be strains on the smaller banks and into private credit on some of these things where, again, it's that same story. When people fell into this trap in 2020 of cash is cheap, loans are very inexpensive, we can take on any project because at 0% rates, almost everything makes sense. They were not looking out and saying, hey, in 3 years, are we going to be able to continue this? Because I don't think anybody the Fed certainly was not sitting there in 2020 into 2021 saying, hey, just a reminder, we're going to be up 5.5% here in 2 years. They didn't think they were going to have to do any notable rate hike. And I think people underappreciated how significant inflation would be, and we're dealing with ramifications.
Incredible. This has been a fun session, Andrew. We're coming very close towards the end. I wanted to give you the last word on anything for our audience to watch out for, any surprises, anything out of consensus that you would say to look out for.
Yeah. So as we're watching the data, the main thing I would be watching here, and as you're listening to, if you're listening to company reporting, right now, the cracks are showing on the lower income groups, the lower credit score groups, where it really starts to flow through and impact the broader economy as it makes its way up the chain. We're watching travel, we're watching leisure and hospitality, where a lot of those groups are spending. We're watching premium brands like Amex to see what they're reporting. That's kind of a higher premium. Watch the data, because that Q3 to a degree, I believe, is a head fake. We'll keep talking about this. Everything that we put out data watches, Monday morning outlooks. We've got a 3 on Thursday. We just started putting out everything that we put out from the First Trust Economics team. From our end, it's retail approved. We're trying to give you content, commentary. We will discuss through that anything that we see happening. But watch out for business investment. If that starts to slow down, if there are higher interest costs or a slowdown in consumer demand across any part of that chain, if we start to see the slowdown in business investment, that's going to be the key piece for us potentially going into a recession. It's not going to be I really don't think it's going to be the consumer. Consumers, broadly speaking, are in okay shape. It's a question of did businesses get over their skis? And we'll be talking about that. If you ever have a question, something you think of tonight, tomorrow, next week, next month, you get an email from a client, a call from your client. They say, hey, I saw this thing on Zero Hedge. Feel free to reach out to our team at any point in time. If we can be a resource to you, as you are a resource to your clients, that's why we exist. And we're happy to hop on a phone call, communicate via an email. Use us if you can.
Certainly, and we certainly have, and we'll continue to do so. We've actually got a really good question here from one of our teammates. Do you think that the Fed might eventually increase the target inflation rate, say, to 3%?
I think they eventually will, but I don't think it's going to happen here in the short term. And the main reason for that is, well, it's twofold. One, the Fed believes that if they were to change the target from 2 to 3 right now, they're losing credibility because they have reiterated over the last 24, 36 months that 2% is their target. They've been asked time and time again. Powell has been in the press conference and he says, no, we haven't changed our target, haven't changed. If they change it now, people are going to be like, oh, when push comes to shove, you move the goalposts. But the other reason they don't want to do that right now is I think the Fed believes it will unanchor the long end of the yield curve, is that if people price in higher inflation, they believe the Fed won't ultimately get it down to 2.5%. They're worried that might push things up even further. And they want to keep control on that right now. Give it 2-3 years and inflation when it's down to 2.5%, and the Fed can say, look, we've pretty much done the job. When people are less focused and there's no threat of a Fed rate hike, I think they'll come out and say, hey, that 2% thing we talked about before, we're going to adjust that moving forward. But they need to wait until there's calm, until they're further along the normalization cycle before they can do that.
Certainly. Well, you mentioned the partnership that we have, and for those that are not using First Trust enough, I would point you to their client resource materials. They've got some amazing research, makes my life easy. It's there in picture form. You guys are really good with UITs and ETFs. So if you're not using them or using them enough, take a look, partner with them. And Andrew Opdyke with First Trust, thank you so much for joining us today. We appreciate your partnership.
Yeah, thank you so much for having me.
Thank you. Good night.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.